Provisions and contingencies. In this lecture, you'll learn the main rules of IAS 37 with the latest amendments. I am Sylvia of cpdbox.com, and you are very welcome to check my website and courses if you want to make significant and fast progress in your IFRS knowledge. The standard IAS 37 has been here for a while because it was issued back in 1998 with the effective date of 1st July 1999, and it was amended in 2020 for the last time. Its objective is to set the criteria and rules for measurement and recognition of provisions, contingent liabilities, and contingent assets, plus set the disclosures required for these items. So, what is a provision? It's a liability of uncertain timing and amount. But what is liability? A liability is a present obligation of an entity arising from past events, the settlement of which is expected to result in an outflow of economic benefits of an entity. So, the critical point here is occurrence of past event or obligating event that gives rise to the obligation. Because if there's no past event, then there's no obligation and there's no liability. Past event might create two types of obligations. The first one is a legal obligation that derives from some contract or legislation or some other operation of law, for example, a court decision. The second one is a constructive obligation that derives from some entity's actions, so what it did, if it created a valid expectations that the entity will take on some responsibility. So that's a constructive obligation, so not by any law, but by expectations. Either way, whether it's legal or constructive, it does not matter. There is a past event. When should we account for a provision or recognize a provision? If all of three following conditions are met. Number one, there must be a present obligation, whether legal or constructive, as a result of some past event or obligating event. And we have just discussed that. Number two, the outflow of economic benefits required to settle the obligation must be probable. And there is high probability of having to pay than not having to pay, and in numerical terms, more than 50%. Number three, there must be reliable estimate of outflow of economic benefits that is required to settle the obligation. So we must be able to determine how much. In extremely rare cases, when no reliable estimate can be made, liability exists, but it cannot be recognized. So when deciding on recognition of provision, we must assess all three conditions. If all of them are met, then the provision is recognized, and if not, or just one condition is not met, then entity just discloses contingent liability if the outflow is possible, or nothing if the probability of outflow of economic benefits is remote. Here, in order to decide whether to recognize a provision or to disclose a contingent liability or even to do nothing, the standard IAS 37 gives us a decision tree, and if you're interested, you can also check that out in our complex course, the IFRS Kit. If you find yourself in a situation when you're questioning whether to book a provision or not, you should ask yourself one simple question, and the answer will guide you. Can you avoid the obligation by some future actions? If yes, then do not recognize any provision because it means that there is no past obligating event. For example, if government is introducing new laws and your company must train the employees to stay updated, your company may just decide not to continue in business or not to train personnel and thus avoid the expense. But if you really cannot avoid expenses by any future action, then you must make a provision. For example, if you promise warranty repairs when selling some products to your customers, then you must make a provision for expected costs associated with warranty repairs. Let me explain contingencies. An entity may face both contingent liabilities and contingent assets. Contingent liability is either possible obligation arising from past events, and its existence will be confirmed by some uncertain future events which are not wholly in our control, or alternatively, its present obligation that arises from past events, but outflow of economic benefits is just possible, so probability less than 50%, or it cannot be measured reliably. Contingent asset is something similar. It's possible asset that arises from past events and whose existence will be confirmed later, either by occurrence or non-occurrence some future events. Neither contingent liabilities nor contingent assets shall be recognized in financial statements. That means no accounting. But we must disclose their existence, their nature, estimate of financial effects, and indication of uncertainties, possibility of any reimbursement. So disclosures are made in the notes to the financial statements. How shall we measure provisions? Well, provisions should be measured as the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. And so this estimate of outcome and financial effect are determined by the judgment of the management based on their experience of similar transactions, or sometimes based on reports of independent experts, but it's still judgment. There are two most common ways of measuring provisions. The first one is so-called expected value. So you have a lot of probable outcomes. Each comes with probability and you calculate some weighted average. The second method is used when a single obligation is being measured, so then a provision would be set as the most likely outcome. When measuring provisions, there are several considerations we must look at. So first of all, risks and uncertainties like inflation, for example. Discounting. So if you expect to settle the provision in more than 12 months, you need to set its present value. And then also we must make certain adjustments for future events if they are probable to occur. Now, there are certain specific situations directly addressed by IAS 37 in relation to provisions. The first one is future operating losses. Well, future operating losses do not meet the definition of a liability because there is no past event, so the entity has no obligation, neither legal nor constructive, and therefore standard IAS 37 prohibits recognizing a provision for future operating losses. But instead, expectation of future losses might indicate that some assets are impaired, and therefore an entity must perform an impairment test and recognize some potential impairment in accordance with IAS 36. Another specific area addressed by the standard relates to onerous contracts. Onerous contract is unfair contract in which the unavoidable costs of meeting the obligation under the contract exceed its economic benefits expected to be received under it. In other words, it is a loss-making contract that cannot be avoided. If a company or an entity identifies certain contract as onerous, then it must recognize a provision in the amount of unavoidable cost of fulfilling the contract. So what is unavoidable cost? It is either net cost of fulfilling the contract, and that means some costs less some income from the contract, or penalty from non-fulfilling the contract, whichever is lower. But first, we should recognize any impairment of assets related to that unfair contract. Now, there was an amendment of IAS 37 applicable from 1st January 2022 related to costs of fulfilling a contract that specified what those costs are. So they are both incremental. These are directly related to that contract, like materials or labor, and allocated. For example, some portion of depreciation charge of a machine used for the contract is allocated cost. The third specific situation addressed by IAS 37 is restructuring. It's a program that is planned and controlled by management and that materially changes either the scope of business undertaken or the manner in which that business is conducted. So You must recognize a provision for restructuring when two conditions are met. The first one, there is a detailed formal plan with some minimum information about the related business, location, employees, expenses, schedule, and other things. And the second one, valid expectations must have been raised by the company in those affected by the restructuring. And IAS 37 then specifies that what components or types of expenditures can and cannot be a part of a provision. So this was a short summary of the main IAS 37 rules. Thank you for watching, and if you'd like, subscribe to this channel and hit the notification bell or visit my website for the free newsletter. Thank you. Bye-bye.